vocabulary highlighted in the book The Common Sense Guide to Investing by Upshaw. 1. This book is not about becoming wealthy quickly, winning the market, or forecasting the future. This book is about utilizing easy and practical strategies to regularly and securely develop your money. 2. The premise of this book is that investing is not rocket science, but rather common sense. The capacity to think sensibly, logically, and realistically is referred to as common sense. 3. Investing is distinct from saving, which involves storing your money in a secure location, such as a bank account, where it yields little or no return. 4. Saving will not help you expand your wealth or combat inflation, which is the gradual increase in the cost of goods and services. 5. Investing may also assist you in generating passive income, which is money earned without working, such as rent, royalties, or dividends. 6. Passive income may provide you with greater financial independence and stability, since it does not rely on your active income, which is money earned by working, such as salary, wages, or commissions. 7. Inflation diminishes your money's buying power, which means you can purchase less with the same amount of money over time. 8. However, if you invest in a diverse portfolio that yields 7% interest each year, your money will grow in value over time, since the interest rate is larger than the inflation rate. 9. Passive income may also assist you in achieving financial independence, which is defined as having enough money to pay for your living needs without working. 10. Establish your objectives. The first step in investing is to establish your objectives. 11. Return, risk, liquidity, and diversity are all characteristics of different types of investments. 12. For example, if you desire big profits and can manage high risk, you can consider investing in stocks. If you desire modest returns and little risk, you might consider investing in bonds or cash. 13. Stocks are often referred to as equities or shares. 14. Stocks are also quite volatile, which means that their prices may fluctuate quickly and unexpectedly. Stocks are appropriate for long-term investors with a high risk tolerance and a drive for growth. 15. Bonds. Bonds are loans made to the government, corporations, or other entities. When you purchase a bond, you are lending money to the issuer in exchange for a predetermined amount of interest, known as the coupon, and the principal, or the initial amount of money, at a specified date known as the maturity. 37. Interest is money earned by lending your money, such as bonds or bank accounts. Dividends are payments made to you as a result of holding a share of a corporation, such as stocks or mutual funds. Capital gains are the profits you get when you sell your assets. 38. Quality investments are more likely to outperform the market over time and to endure downturns and shocks. 39. Search for earnings. The first advice for selecting great stocks. 40. Earnings are also the primary driver of stock prices, since they represent a company's prospects and possibilities. 41. For example, if you want to invest in a technology firm, search for one with a high EPS, strong earnings growth, and high earnings compared to its rivals, sector, or the S&P 500. 42. Seek for value. The second advice for selecting great investments is to seek value, which is the difference between an investment's price and its worth. 43. By searching for value, you may uncover undervalued assets, meaning they are worth more than they cost, and that provide a margin of safety, defined as the gap between the price and the inherent value of an investment. 44. For example, if you want to buy in a utility business, search for one with a low P/E ratio, a high dividend yield, and a cheap valuation in comparison to its rivals, its industry, or the S&P 500. 45. Potential also denotes how much an investment may profit from trends, changes, or advancements in its industry, market, or environment. 46. Diversification may aid in risk reduction, since various investments may respond differently to the same market circumstances or occurrences. 47. Return, risk, liquidity, and diversity are all features of each asset type. 48. The second recommendation for diversifying your portfolio is to diversify within asset classes, which are investment divisions like kinds, sectors, industries, geographies, or themes. 49. Cash may also be classified as money market funds, certificates of deposit, or treasury bills, depending on the kind of instrument or currency. 50. Rebalancing is the act of selling assets that have grown more than planned and purchasing investments that have grown less than expected to return your portfolio to its original or target asset allocation. 51. Asset allocation is also the most personal decision an investor can make, since it is determined by their goals, preferences, and circumstances. 52. The core guideline of asset allocation is to maintain a balance of risk and return. 53. In general, there is a trade-off between risk and return, which indicates that the greater the reward, the higher the risk, and vice versa. 54. The second asset allocation criterion is to think about your time horizon. This suggests that you should choose an asset allocation strategy that is appropriate for your investment term. 55. In general, the longer your time horizon, the more risky assets, such as stocks, you may invest in, and the shorter your time horizon, the more safe assets, such as bonds or cash, you should invest in. 56. If you just have a year to save for a vacation, you should take less risk and invest more in bonds or cash. 57. This means that you should review and revise your asset allocation frequently, such as once a year or whenever your goals, preferences, or circumstances change. 58. Your financial ambitions, expectations, or obligations may change if you marry, have a child, or lose your job, requiring a change in asset allocation. 59. These hazards are not visible or simple to avoid, rather, they are subtle and difficult to resist. They are the adversaries of common sense investment. 60. Market timing. Market timing is the first fallacy of common sense investment. 61. Market timing, on the other hand, is a risky and expensive trap that exposes you to lesser returns, more risk, and higher expenditures. 62. It is impossible. The first reason market timing is a trap is because it is difficult to achieve. 63. The second reason market timing is a trap is because it is expensive. This implies that when you trade more often and for a shorter period, you will have to pay more fees, commissions, and taxes. 64. As you expose yourself to more changes and emotions, you will have to cope with increased uncertainty and instability. 65. If you attempt to time the market, for example, you may panic and sell when the market falls, get greedy and purchase when the market rises, or repent and chase when the market swings against your forecast. 66. This implies that you follow the herd and acquire assets that have lately done well or sell investments that have recently performed badly, without analyzing their fundamentals, value, or prospects. 67. Chasing returns, on the other hand, is a risky and expensive trap that exposes you to lesser returns, increased risk, and higher expenses. 68. This indicates that you make choices based on emotions like greed, fear, or jealousy, rather than rationality like analysis, assessment, or judgment. 69. As a result, chasing returns leads to the purchase of expensive and overhyped assets, and the sale of underpriced and unappreciated opportunities, rather than the purchase of excellent and undervalued investments, and the sale of inferior and overpriced investments. 70. The primary investing concept is to buy low and sell high, which means to purchase assets when they are cheap and sell them when they are costly. Pursuing returns, on the other hand, causes you to do the opposite. You purchase high and sell low, meaning you acquire assets when they are costly and sell when they are cheap. 71. This is because the market is cyclical and mean reverting, which means that it has ups and downs, but tends to return to its average level over time. 72. Overconfidence is a trap since it leads to the taking of excessive or needless risks, as well as the disregarding or overlooking of essential facts or circumstances that might damage your investments. 73. The first reason overconfidence is dangerous is because it is skewed. 74. For example, if you are overconfident, you may be prone to confirmation bias, which is the propensity to seek, interpret, and recall information that supports your ideas while ignoring, rejecting, or forgetting information that contradicts them. 75. You may also be subject to hindsight bias, which is the propensity to assume that you knew or anticipated the result of an event after it occurred while ignoring or forgetting the event's ambiguity or unpredictability. 76. You may also be subject to self-serving bias, which is the propensity to credit your triumphs to your qualities, while attributing your failures to external causes such as chance, the market, or others. 77. For example, if you are overconfident, you may invest in a firm that you believe is fantastic without doing enough due diligence, such as analyzing its financial statements, competitive advantage, or development prospects. 78. Loss aversion is a trap because it may induce you to keep losing assets too long in the hope that they will recover, or to sell winning investments too quickly, in the fear that they might drop sometime. 79. The fundamental rule of investing is to cut your losses and let your profits run, which means that you should sell your assets when they are below your tolerable loss level and retain them when they are above your projected gain threshold. 80. As a result, if you have loss aversion, you are more likely to lock in your losses and lose out on your gains, reducing your returns and wealth over time. 81. Books are the primary resource for sensible investment. 82. One Up on Wall Street by Peter Lynch is regarded as one of the best books on growth investing. It's written in a clear, succinct and humorous manner, it's reasonably priced, and it's widely available.